Hey traders, Nick Shaheen here. Taking the opportunity of a real life example to do a tutorial on a spread. In this case it's a call spread, and it's not a vertical spread, it's a diagonal. So I'll quickly explain, hopefully quickly, the difference between all three. Now this is a real life example for a trade I did today. It's a lottery ticket on earnings. To me, earnings are always a lottery ticket because even if they hand me the P&L ahead of time, I couldn't guess how they're going to move up or down. So the results don't really matter. This is SPLK, SPLK ticker. What are we looking at here? A 4-hour chart, so every tick is 4 hours. And they're reported after the market closed. So this doesn't show the move after the market. It rallied. And then gave it back up, and I think it's trying to come back. So let me show you a visual of the trade itself. Okay, let's see if I can do this without messing it up. All right, so here is the option chains. So if I wanted to go long the stock, I can go long the stock by buying it, obviously, or I can use the options, which are cheaper with bigger bang for the buck. The only difference is the options have a time limit on them. They expire. In this case, they have weekly options that expire. In this case, not every ticker has weekly options, and not every ticker has options. And this one, SPLK again, SPLK, it has an option contract that expires in 1 day, tomorrow. Today's Thursday, tomorrow's Friday. And then one thereafter, a week. And then 2 weeks, and then a monthly, which is 3 weeks, 4 weeks, etc. So this one has 1 day, and this one has 8 days. So we're talking about these two check marks right next to them. So this applies to any point in time. It could be like a year from now or a year ago. The same concept is the same. The same concept applies. At the time I executed this trade, the prices were under 100. In fact, I bought this one first, and then it rallied it throughout the day, and then I decided to sell against it. So I wanted to bet, emphasis on bet. I don't know how they're going to react. It's a short-term bet. I don't have a lot of conviction in it, so I don't take a lot of them. I buy a call. These are calls. Forget about this side. This is puts. And so I bought a 108 call, meaning I bought a lottery ticket that says if it goes to 1 million by next week, I hold a ticket here for me to allow me to buy it at 108. Okay, I'm using exaggerated million. But if it goes to 110, same concept. I can buy it at 108, so I guarantee myself a $2 profit. But I have to pay for that, and it expires. So if nothing happens, I lose my money. If it goes down, I lose my money even faster. And if it spikes 120, then I made $12 per share minus what I paid for the bet, right? So the cost, I can't remember exactly what was my entry point, but it was under $3. And then the market rallied, well, SPLK rallied, so it became more expensive. So I made money already just on the bet itself. I could have sold it and closed it for a small profit. But this was a bet I was making for the aftermarket and tomorrow's open. So I said, instead of selling the call I just bought, I want to spread it. Now I could do a debit call spread, meaning same time frame, I would sell a call above it, right? So let's say I paid $3 to buy the 108, and now it's $3.40. So I made 40 cents a contract, right? On 10 contracts, that's $400. And let's say now it's $3, a little more, to sell the 109. So I can literally sell the 109 to enter into a debit call spread, and now I'm basically free long a stock through that spread. I have limited upside because if it goes to 1 million, the only thing I can make is $1 per contract, so $1,000 on 10, for example. But that's the concept of spreading. So I wasn't interested in that. This was a lottery ticket. So I wanted to do something that will give me more bang for the buck if and only if I guessed it right direction and the right amplitude, meaning how big of a move it's going to be. The market was pricing in, if I remember correctly, about a 10% move. So about a $10, it's easy round numbers, about a $10, $11 move on tomorrow. So it's either going to be 110 or 90. That's the guess of the market, somewhere in between those two. So I bought the 108 somewhere in between, right, on the upside. So I said, okay, so how can I leverage this asset? I want to spread it, but without limiting myself too much. So I decided to sell the 113 call. So not the 109, 10, or 11, or 12, or 13, the 13. But I did even better. I didn't sell it for the same time period. I sold it for one that expires tomorrow. So I collect less, but I have very limited upside. I don't have a lot of limitation on the upside because this one expires tomorrow. So unless they jump 13%, this one's going to die on the vine, meaning it's going to expire for free. So I collected over $1. So now my entry, if it was $3, now it became $2 because I collected $1 for selling the call. To recap, to go long, I bought the 108 call that expires next Friday, the 7th December. I paid $3. Then I decided after a run-up that I want to do a spread instead. I sold the 113 call that expires tomorrow, one day. And I collected $1, a little more actually. I collected $1. So now my total entry cost is $2, and I'm holding a spread. The name of that spread is a diagonal because I bought a call and then I sold the call shorter in time, but I didn't sell it the same level. I sold it higher. So what does that do? So now I'm long this one and short that one, right? So this one gives me an opportunity. If it shoots up, I start making money. The other one limits it, but the other one dies first. So even if it goes to 1 million, I still make money because this one is at 113. So I'm long at 108 and I have to be out at 113 in theory. If it goes to 1 million, I get called away at 113. So I still made $5 on the difference between the two minus what I paid up front. So $3 net. But most likely tomorrow it's not going to go above 113, and therefore that dollar is just going to go to zero. But I collected it, so whoever is on the other side of my trade lost $1. I sold them that $1. They took it. They thought it was going to go to 113 by tomorrow, and it didn't. Let's say it went to 109 or 108 or 107. This one is going to be a lot more than $3 because now price, which is 100, now becomes here somewhere. And so I'm left long 108 calls for the week thereafter that are now a lot more than $3. So in the morning, I can go ahead and close the whole trade and book the profits. Or if it continues on higher, I choose to hold it, roll out of it, and do all kinds of other spreads thereafter. Or buy the stock like I said I would want to buy. If it goes to 115, I'd exercise my right to buy it at 108 and hold it, for example, and then start selling calls against it. But the point of this video is to explain the difference between a regular debit spread, calls or puts. This way, this example is just calls, real life example, or the diagonal, which is really a calendar spread offset a little bit. Let me see if I can explain it from a different angle, just to hammer the point home. Okay, but first, let me show you. Let me see if I can show you this one. So this is like a few minutes after the earnings. They rallied up to 111 and then faded. I think they went red, and then last time I looked, they were somewhere around here. So, but the point is, they got to 110, which is what the market was expecting, either 110 or 90. They went to 110. So in that scenario, right? If you remember correctly, this is what I was looking at. I'm gonna get a new scratch pad. Okay, so I was long to 108. So right here I start making money because price ran through, and then I was short the 113, right? So, but this one had only 1 day left on it. Tomorrow at the bell it expires. So let's say it goes up, it stays at 110. 112, 112.99, even 113 really, then I can close it for a penny or two at the end of the day. Let's say it stays under 113. This one goes to zero. Now I'm still long this one at 108. So now I'm long the stock in theory at 108. But in this case, I'm long the call, which is the option to buy the stock, which is not the same as owning the stock. I'm not forced to buy it. I have the opportunity to buy it if I want to. So I usually don't exercise my right and say, hey, give me the stock. I usually just sell the call at an exploded premium. I paid $3 for it. I didn't really. I paid $2. Remember, because I paid 3, but then I collected 1, which died. So I really paid 2. Okay, so now I'm long that call option for 2, and I bet you it'll be $4 if not more, if price is anywhere near it. I can hold it because as long as price goes up, this number will explode and explode. And the premiums really are leveraged. So let me see if I can show you an example here. Okay, so this is the snapshot just before they close, right? The stock was up 2%, 2.5%. The stock was up 2.5%. The options were up 30. So if I bought the stock, I'd be happy. I made 2.5%, right? But if I bought the options, I made 30% on the same exact move in the stock. So bigger bang for the buck, but time limit. You know, if you don't get it right, your bet is gone. You're betting smaller money than paying $100 a share. You're buying, you know, $1 per 100 contracts. So $100 basically. If you wanted to do one contract, 10, it'll be $1,000 versus, you know, how many thousands in order to own the shares, the equivalent shares. So bigger bang for the buck, provided you get the time and direction correctly and size of the move. So it is a good way of making a bet. These work great if you have a chart that you can see a move coming and you know that it's a fundamental move. So let's say there was no earning and I say, okay, this looks pretty darn good to me, and I'm a technician and I can plan on, okay, so fail, we're coming against it. If they close above it, you know, they sure look like they want to move up by that much, and this could be the target. So I want to take a bet for the next couple of weeks or 3 weeks or a month or a year. It depends on the time frame. I don't care what the sticker is. I'm just looking at something. Technically, this looks bullish if they go up. So I place an alert. As soon as I see this tick up, say, you know what? I'm going to give it a shot. Maybe I'll put the alert higher to be sure, because this was another fail level, and so was this. So it all depends. But the point is, I play with options in order to make the bet. So in that case, I buy a call, or I buy a call spread vertical, or I buy a call and sell a call shorter in time, which would be a call calendar, or I buy a call and then sell a shorter period of time one higher diagonal, which is what I just did here and what we went through. Again, I buy a call, say for 2 months out, for January, for example, and I decide to lower my entry cost, sell something else against it. I sell a call that's shorter in time, let's say December, but higher. So that's a diagonal. See why it's called a diagonal? Okay. If I had sold it at the same level, then it would have been a calendar, because I'm only playing calendar. December, January. I buy, I sell. Maximum loss is the money I spend, because if it goes to $1 million, I'm short here, but I'm also long here. I can't do the opposite. I can't sell and buy. I could, but then I'll be, you know, exposed short for a period of time. So, calendar, diagonal, vertical. Okay? So, calendar, diagonal, vertical spreads. These are calls. On the puts, works the same way. I buy a put, I sell a put. That's a vertical. I buy a put, I sell a put, same level, calendar. I buy a put, I sell a put, lower, diagonal. Make sense? I can make the diagonal this way, but then again, that exposes me to extra losses. I don't want to go there. It's a completely different subject. All right, next signing out. If you have any questions, you can email me at sellspreads@gmail.com.